Imagine never setting an alarm clock again. No Monday meetings. No waiting until 65 to finally live your life. Sounds impossible, right? But in the next 10 years, you could be done working without winning the lottery, inheriting a fortune, or building the next tech giant. The secret isn't luck. It's a system, and one that works quietly in the background, turning your dollars into employees until they make more money than you do. Most people will work for 40 or even 50 years. Not because they love their job, but because they believe they have no choice. They think retirement is something that happens far away, at the end of a long, exhausting road. And because the finish line feels so distant, they live as if there's no other option. Here's the trap. You start working. You earn a paycheck. You spend what you need and what you think you deserve. If you're lucky, you save a little. You might even try investing. Maybe you watch a few videos, open a brokerage account, buy some index funds or dividend stocks. But after a few months or a couple of years, you look at your account and think, that's it? That's all I've got to show for it? The growth feels microscopic. The progress feels invisible. And so, people give up. They convince themselves that early retirement is only for millionaires, Silicon Valley founders, or finance YouTubers. But here's the truth. The reason you don't see results in the beginning isn't because the system doesn't work. It's because you are still the system. In the early stage, your wealth isn't growing because of compounding. It's growing because of your effort. It's like pushing a snowball uphill. At first, it's small, heavy, and every inch depends entirely on you. Your money is still passive, dormant. It hasn't reached the point where it works without you, and that's why most people quit right before the tipping point. They walk away just before the slope starts to tilt in their favor, and they miss the moment when their money finally starts running ahead of them. There's a simple math trick that can tell you exactly how long it will take to double your money. It's called the Rule of 72. Take the number 72, divide it by your annual return rate, and the result is the number of years it takes to double your wealth. Let's say your investments grow at an average of 10% per year, a realistic long-term target if you combine U.S. stocks, real estate, and some high-yield bonds. 72 divided by 10 equals 7.2 years. That means every 7 years, your money doubles. Start with $50,000. In about 7 years, it becomes $100,000. 7 years later, $200,000. Then $400,000. And the magic isn't just in doubling. It's in how the growth starts small and then explodes. At first, the extra money you earn from investments is barely noticeable. A few $100s here, a few hundred there. It feels like watching paint dry. But compounding is like gravity. It pulls harder and faster the bigger the object gets. By the time you have $100,000 invested, a 10% return gives you $10,000 in 1 year, without you lifting a finger. At $500,000, it's $50,000 a year. And at $1 million, it's $100,000 a year, more than most people earn at their jobs. And here's where most people get it wrong. They underestimate how much time can work for them, and overestimate how much they can do in the short term. They want results this year. But compounding rewards those who can stay in the game for enough years to let the curve bend upward. The Rule of 72 isn't just math. It's your early retirement clock. And the sooner you start, the sooner the countdown begins. Let's say you're starting today with no investments. $0 in the market. Your goal, in the next 10 years, build enough invested wealth that your money can cover most, or all, of your living expenses. Here's the reality check. If you only rely on your current income, save a small percentage, and invest it passively, you might get there. But only if you earn enough and keep your expenses low. If you're earning $4,000 a month and saving 10%, that's $400 a month. Even at a solid 10% return, you'd have around $77,000 in 10 years. It's a good start, but not enough for full retirement. So here's the first mindset shift. You can't just save your way to early retirement. You need offense, more income, and defense, keeping more of what you make. If you can grow your monthly income to $10,000 and still save 10%, now you're investing $1,000 a month. In 10 years, at a 10% return, that's about $193,000. That amount, combined with other income sources like rental properties, dividends, or even partial Social Security, could put you much closer to living without a paycheck. And here's the secret weapon. Every time your income rises, keep your lifestyle exactly the same for a while. If you earn an extra $500 a month, put it straight into investments. Most people use raises to upgrade their car or move to a bigger apartment. That's why they work for 40 years. Instead, treat every extra dollar as a worker you've just hired. Put them in the field, not in the showroom. The more workers you hire early, the sooner they start bringing in new recruits of their own, and the sooner you can step away from the job site. If you want to retire early, your portfolio can't just be safe, it has to be efficient. That means balancing growth, income, and risk in a way that keeps your wealth compounding without constant interference from you. Most people think of investing as buy some stocks or put it all in a savings account. But that's like building a house with only one type of material. It might stand for a while, but it's not prepared for every storm. A well-built early retirement portfolio has 3 layers. Growth assets, these are your engines. U.S. and global index funds, strong dividend-paying companies, and growth stocks that can outpace inflation over decades. This is where you get the capital appreciation that fuels long-term wealth. Income producers. These are your cash flow machines. Real estate investment trusts, REITs, dividend stocks, and in some cases, rental properties that can give you steady, predictable income. Money you can actually spend without selling your core assets. Stability and protection. These are your shock absorbers. Treasury bonds, high-yield savings accounts, and even a small portion of gold or commodities. They may not grow as fast, but they protect your portfolio during market drops and give you liquidity when you need it most. And here's the overlooked piece. Currency diversification. If all your money is in US dollars, you're tied to the fate of one economy and one currency. Holding a small percentage of your assets in international markets or even in strong foreign currencies can protect you against unexpected downturns. A portfolio like this won't give you the highest return in any single year, but it will keep you in the game for decades. And that's how compounding works its magic. Because the ultimate risk to early retirement isn't a bad year in the market. It's you being forced to sell your assets too soon, just to cover the bills. With the right balance, your money isn't just sitting there. It's growing, generating income, and protecting itself all at once. There's a dangerous myth in personal finance that once you've built your nest egg, you can just stop adding to it and let it ride. That works. If you're okay with inflation quietly eating away your purchasing power year after year. Here's the truth. If you want your wealth to last for the rest of your life, especially if you retire early, you need a plan for continuous reinforcement. That starts with adjusting your contributions every year. If you're investing $1,000 a month today and inflation averages 3%, next year you should aim for $1,030 a month. Not because you're greedy, because the cost of your future life just went up. The same applies once you're retired. If your portfolio is producing $6,000 a month in passive income, don't spend it all. Reinvest a portion, even 10 to 20%, so your capital keeps growing enough to outpace inflation. This is where most early retirees fail. They treat their investments like a paycheck, something to be spent down completely each month. But if you eat into your principal every year without replenishing it, you're on a countdown to zero. Instead, think of your portfolio as a forest. You can live off the fruit and fallen branches, but you never cut down the trees. And here's where things get interesting. Even modest increases in your contributions can change your entire retirement timeline. If you start with $1,000 a month at 10% return for 20 years, you end up with about $760,000. But if you increase your contributions by just 3% each year, you end up with over $1 million without feeling a huge difference in your budget along the way. Inflation isn't the enemy. Failing to prepare for it is. And the easiest way to prepare is to make growing your investments a permanent habit, not a temporary sacrifice. There's a cruel trick built into the journey to financial independence. In the first few years, it feels like nothing is happening. You save, you invest, you skip luxuries, and your account barely moves. A year goes by and your balance is up just a few $1,000s. It's frustrating, it's boring, and it's exactly the point where most people give up. Here's the problem. Compounding works like a slow-motion avalanche. In the early stage, the snowball is tiny. It grows slowly, almost invisibly, but once it gets big enough, gravity takes over. And that's when it starts to move fast. The danger is quitting right before that shift happens. And it happens all the time. People look at their account after 3 or 4 years and think, if it took this long just to get here, I'll never make it to retirement. So they stop contributing. They sell investments. They blow the money on something that feels like living in the moment. What they don't realize is that they were standing 1 or 2 steps away from the curve bending in their favor. And here's the truth. The hardest part of building wealth isn't the math. It's the patience. It's continuing to feed your portfolio during the years when the payoff is invisible. Think about it this way. If you plant a seed, you don't dig it up every week to check if it's growing. You water it. You protect it. You wait. Wealth works the same way. The first stage is invisible growth. The second stage is unstoppable momentum. Your job is to survive the first long enough to enjoy the second. Something magical happens when your invested wealth reaches a certain size. One day, you'll check your account and realize it grew more last month than you earned from your job. That's the tipping point, when compound returns officially overtake your labor as the primary driver of your net worth. At $100,000 invested, a 10% return gives you $10,000 in a year, the equivalent of a month's salary for many people. At $500,000, that's $50,000. At $1 million, it's $100,000, without clocking in a single day. From here, your role changes. You're no longer the one pushing the snowball up the hill. You're steering it downhill, making sure it stays on track and doesn't crash. And this is where early retirement becomes less about effort and more about structure. The key is to resist the temptation to spend that new growing income as fast as it arrives. If you reinvest it, even half of it, you accelerate the curve dramatically. It's the difference between cruising toward retirement at 60 and slingshotting toward it in your 40s or early 50s. At this stage, the risk isn't losing money. The real risk is losing discipline. Because the moment your money starts working harder than you is the moment you have the most power and the most responsibility to protect your future freedom. Early retirement isn't just about numbers. It's about becoming the kind of person who protects freedom once you have it. Before the tipping point, your questions are, how do I earn more? How do I save more? How do I invest better? After the tipping point, the questions change to, how do I make sure this machine runs forever? What habits protect the life I've built? What systems make sure I never have to start over? You stop seeing money as something to spend and start seeing it as something to deploy. A $100 dinner out isn't just a meal. It's the cost of delaying your next milestone. A $500 impulse purchase isn't just a splurge. It's a worker you fired before they could earn for you. Every decision has a long-term echo. And when you think that way, you stop chasing temporary pleasures and start building permanent independence. The hardest part is surviving the quiet years, the ones where nothing seems to be happening. The easiest part is enjoying the years when the curve has already bent in your favor. So the real challenge is this: can you keep going long enough to reach that moment? Because once you do, you'll realize that the first 10 years weren't the sacrifice. They were the shortcut. Every dollar you invest today is a silent worker that never clocks out, never asks for a raise, and never calls in sick. Give it a job. Let it work for you. If this video gave you a clear roadmap to financial freedom, like and subscribe for more stories that reveal how money really works and how to make it work for you. And if you want to go deeper, don't stop here. Click on one of the videos on your screen right now. Each one will take you further into the strategies, history, and mindset shifts that can change the way you build wealth forever.